As I mentioned, we designed the plan until 2030, where the first 3 years are our commitment, the second 3 years are objectives, and the remaining years are directional. And this holds true for our financial targets. So let's take a closer look at the numbers. As we discussed last week, we posted record results in our first year and have built a very solid basis as we shift to become a sustainable mobility tech company. By 2030, we expect revenues will double to 300 billion euros. As you know, we will incur incremental costs related to electrification over the next several years as we make this shift. However, we will begin to offset these costs with the new revenue streams we have discussed, such as software and connected services, mobility and financial services, as well as through the synergies we will continue to achieve as a result of the merger. Stellantis will manage the transition period towards electrification while protecting our double-digit margins and maximizing our shareholder return. We are taking several actions to stabilize our industrial free cash flows, one of which is to normalize and frankly reduce our negative working capital. This will not happen overnight and will result in an approximate 3 billion euro negative impact on industrial free cash flows in 2024. Industrial free cash flows will reach more than 20 billion euros in 2030 due to a strong growth and profitability. We'll continue to target to be the most efficient automaker with respect to our capital spending and target CapEx and R&D around 8% of net revenues. Let's take a closer look at the drivers for our revenue growth. As I previously noted, our revenues will double to 300 billion euros by 2030. This is the result of many factors, including our assumption that the global industry will grow by 25% versus 2021 to 94 million vehicles in 2030. Revenues will also improve with our increased BEV mix, representing a shift from 3% to over 50% of global revenue. And our software and services businesses will grow more than 800 basis points to 20% of total revenues in 2030. This includes, among other revenue streams, annual revenues from software-enabled products and services of 20 billion euros and 20 billion euros from parts and services. As we discussed earlier, we are also expecting revenue growth outside of North America and in large Europe, which will lead to an improved mix. Today, around 85% of our net revenues are generated in North America and in large Europe. In 2030, 28% of our net revenues will come from outside of these two regions, including more than 25% from our third booster engine. Last but not least, there will be a positive evolution in the new car revenues for the premium and luxury brands, which, as I said, will move from 4% to 11%. Our number one priority has and will continue to be to invest in and develop our businesses, while also rewarding our shareholders. In the midterm, we have multiple priorities, as you can see. We'll continue to invest in product, technology, software, JVs, the US Finco, and our people. We'll maintain strong liquidity and generate free cash flows that allow us to set a dividend policy with a 25 to 30% target payout ratio. In addition, we will allocate capital to be able to execute a share buyback program of up to 5% of our share count. As evidenced by our record results in 2021, we have proven Stellantis is well positioned to deliver strong performance, even in the most uncertain market environments. So to wrap up,